very good afternoon, everybody. So we are back with yet another edition of Netra for the month of October. So in the past month, there's been a lot of talk around a few key things. US debt making new highs every day, with Fed depleting its US treasuries. In the latest FOMC meeting, Fed paused after 11 consecutive rate hikes. Now the question has kind of moved from how high to how long. Now, while the earnings trajectory has remained robust in India so far, it might take a fall with disinflation setting in commodity prices, and not to miss the fast and the sharp rally in the mid and small cap space. So, in our edition for Netra, this month, Sahil breaks it down very comprehensively and clearly, helping you put a more informed and a more pronounced perspective to all these complex data points. Now, also during the course of the presentation, you guys can put in your questions in the question answer tab on your screens, and we will collectively take it towards the end of the presentation. Over to you, Sahil.
Thank you, Pragati, and thank you everybody for logging in today. So as promised, we are going to talk about Netra. We release this report 5th of every month. This month we had an event. Post we wrote the report, we saw this new conflict take place between Israel and Hamas. So I'm going to start this discussion with that, keeping that in mind as the most important discussion point and agenda point today. So at the beginning, I will talk about my take on how I see this situation, and I will share some maps, a little bit of a history. So today you will have to bear extra 10-15 minutes with me, and then we'll go and deep dive into Netra, and we'll try and link both the important events that they have happened together. So let me start off with this most important event and how do we make sense of it. So one disclaimer before I start and we chat about all the various aspects. I'm going to use some maps. All these maps are taken online, and we have no intention to show any international boundaries. And this segment, which I'll talk about geopolitics, is only going to be live. It's not going to be available online. And largely because we are not taking any sides here, no political opinion or ethnic opinions that we're going to take. We are largely going to stick to what are the repercussions for financial markets. But for that, we'll take a look at history and try and understand why are we talking about this conflict today. And I have seen that a lot of market participants believe that discussions around geopolitics are hard because data and understanding is going to be very, very difficult, and it's very hard to make ends meet. But I'll try to make it short and give you the perspective on what we believe is important. So first, we look at what are the most important choke points in the world. So there are two very important takeaways whenever there is a conflict in Middle East and West Asia, to be precise. People talk about crude oil. The first discussion point is that where did crude oil open? And what I've seen over time, over many decades, what has happened is that when any event occurs, people start with looking at financial markets first. If they have reacted violently, usually the consensus become that the event is very important and a lot of it is discussed everywhere and repercussions are thought about. But if the market movement is small, if the initial reaction is small, people usually dismiss the event as unimportant and not very impactful. For this particular event, I think this is an event which is sort of a reverse taper. My understanding is that it will expand in scope as we go ahead. The first day may not be a very sharp and important day to take any conclusions. And let me tell you why. So first, look at the world's key maritime choke points. And these maritime choke points tell you that, where do things get stuck if there are crises. And you can see that there are a lot of choke points in Middle East and West Asia. And so these choke points collectively account for about 1/3 of global oil, or even more than that, supplied every single day. So this is something which is going to be very, very important. And this is an international graph. All of us are familiar with Google Maps. So I'm going to take you to Google Maps to make it more logical, and so that you can do it on your own later and see what this means. So this is a live Google Map online, and this is what it looks like, this area. So let's magnify where we are today. So if you look at this region, and if you look at this strait, this is Strait of Hormuz. It accounts for nearly 22% of global crude oil shipments on a daily basis, and this is the biggest choke point in the world where oil can get stuck. Second and very important choke points is Suez Canal. Okay, so if you look at this area, this is where the Suez Canal is. You can maybe magnify it and go deeper. You will be able to see the canal itself, which is very, very small, right? You can keep going. It is a very, very thin canal, which is a big choke point. And I'll tell you what is the significance of these. This is the canal where Evergrande got stuck a few years ago, and it caused a global problem, right? So this is the area where what we are talking about today, and which is in contention. And these choke points have been there for a very long period of time. And what is the current crisis, and why am I showing you these choke points? Two very important segments. So first choke point, which is Strait of Hormuz, and Suez Canal, and Bab el Mandeb, all of them put together control about 1/3 of global oil shipments. On 25th Feb 2022, we did a call when Ukraine and Russia crisis broke out, and we discussed that it may be a short-term pain, but the ability of that crisis to snowball into something very large is limited. And the reason was that the aggressor was oil producer, and the nation which was under threat did not have very significant global trade linkages. It had in a few commodities, but not to a very large extent. This time, the nations involved are neither commodity exporters nor commodity importers to a very large extent, which are the primary, the primary source of problem is in two countries, which is Israel and Gaza, right? And the Palestine. They don't produce any significant amount of commodities, neither do they export. But this area is very, very important, and I will tell you why. So we'll go back to 1916, which is Sykes-Picot Agreement. This is an agreement which was done to break up the Ottoman Empire in 1916. The Ottoman Empire has been functioning for centuries before that, and during the World War I, France and UK, they came to an agreement that it is very important to break up the Ottoman Empire. And in the Arabian Peninsula, they drew these lines, and you can see these various controls, right? Russian control. Russia eventually exited this agreement, and the lines were changed. But you can see there is one important component here called international control. Okay, this international control is was the international city, or what Britishers promised the Jews as their land. And this eventually became a big issue for a very long period of time. And you can see that all these lines that are drawn on the map, they were drawn directly on the map, and it broke up the whole area. All the clans and people who've been living here for thousands of years, they were broken up into various countries, which were occupied or under control of different nations. For example, of Britain, of France, of Italy. Some areas were controlled by Russia. This became a big problem for many countries because border disputes started happening every few decades. And the Sykes-Picot Agreement was a secret agreement, not released to the Arab leaders. And this, I think, is the starting point of these conflicts. These boundaries, where international boundaries were blurred, no countries were clearly demarcated. And even when the boundaries were created, they were not created keeping in mind the ground reality of people living in these areas. They were largely created to serve the interest of the powers at that point in time, and this created huge amount of breakage in the fabric of people living in those countries. And this, I think, is the seed of the problems that we have today. And largely, there is very, very difficult or possibly no solution for what we see here. Jump to today. over time, what has happened is that in about 1940s, mandatory Palestine state was created with the help of British government, and this is what it looked like. You can see on the left, right? This is what the Palestine state looked like, and then in 1947, there was a consensus reached where some Jewish settlements happened within this overall state, and then there was a partition plan which took place in 1947, and there was Israeli land. You can see the white colored land, and there is this demarcation of Palestine land. And then something very important occurred in 1967, which is called the 6-Day War. This is the 6-Day War. So what we saw on the weekend is not a new phenomena. That's what I'm telling you. So this 6-Day War, I'll show you. I just wrote out all the steps, before getting on the call, which I think the most important one is this fifth step, which is the 6-Day War. You can see in 1967, Israel fought Egypt, Jordan, Syria, and in the 6-Day War, and it captured the Gaza Strip, the West Bank, East Jerusalem, and the Sinai Peninsula, right? And this is what Israel captured all of these countries, and this is where the present situation looks like. This is the all of Israel. This is the Gaza Strip, the green area that you see. You can go on Google Maps also. You will be able to see it. And there is also Golan Heights on the upside, and there is West Bank within this area, right? So the green area that you see, not exactly like this, but you will be able to see in the graph. Let's go back to the Google Maps, and then we'll come to the repercussions of what we are discussing today, right? So let's refresh this map so that it's updated, right? So if you look at this map now, you will see that this is Israel, right? And you will go and see West Bank, which I showed you just now, and there is this Gaza Strip right now. So the fighting is happening between Israel and Hamas, which is situated in Gaza, and they are fighting over the control of this land and also the West Bank. So there is a state called the State of Palestine, which is a combination of Gaza Strip and West Bank. And let me now tell you the actors, and we'll come to a very, very important conclusion, right? So if you look at the neighborhood of Israel, there is Gaza, there is Egypt on one side, right? The Sinai Desert. There is Jordan, and then there is Iraq on the upside, right? Let me zoom it out. There is Iraq on this side. There is Lebanon, and there is Syria, and at the back there is Iran, right? At the back there is Iran here. So Iran has axis of influence in this area, and Iran has actors who are in alignment with the thought process that Iran has. And you can see here, this is the influence that Iran has in this area. In Iraq, it has its own forces which are compliant with Iran. In Syria, it has its own forces. In Israel, in Gaza Strip, it has Hamas. In Lebanon, it has Hezbollah. In Yemen, it has the Houthis, right? So this is the influence that the circle of influence that Iran has over a period of time. And you would have read the report saying that the attacks have happened with Iran backing up, the Hamas, right? And this is where the most important takeaway comes. Okay, so over a very long period of time, what we've seen is that there has been a choke point which has developed over this whole region. Okay, and that choke point is many countries encircling Israel and trying to extract a piece of land back to the control of the Palestinian people. It was a more, receptive, a more moderate approach till the time Yasser Arafat was alive with his party, the Fateh. And since then, it has taken a more aggressive approach. And as things stand today, why I said that this is an expanding event, and then let me go to the numbers and start talking about, how does it impact. First is that Gaza and Israel have fought numerous times. I'll show you what I wrote. There is a whole long list of events that I listed out, and you can see 1, 2, 3, 4, 5, 6, 7. This is all the historical conflicts. There is also a 2021 conflict which happened, and the ongoing tensions, right? So there are like a dozen of different conflicts which have happened. None of them have gone, beyond 2 to 3 fortnights. Usually they end up between 2 weeks, 3 weeks. And what is the reason for that happening? Because if you look very closely, it's a very small piece of land. And let's go back to the Gaza Strip. On one side, there is sea. On the other side, there is Israel. On the third side, there is Egypt, the Sinai Desert. Gaza is not allowed to get, inward trade flows from any of these areas. Israel does not allow it. It only gives its electricity and humanitarian aids, which it has stopped yesterday. Egypt does not allow it. It cannot use the port because it is heavily guarded. So what it does, it has dug up tunnels from the Sinai Desert all the way going down and to get its supply from Jordan. And these are the tunnels which help Gaza survive for a very, very long period of time. Right? And what we have seen is that whenever there is a conflict which takes place, these supplies are cut off, and which allows Israel to have a very large influence, and the war usually ends up very, very fast. Now there are two scenarios which are very important going ahead. First scenario is that if the conflict ends in the next 10-15 days, most likely it will be like the conflicts that we've seen in the past. But the problem with this scenario is that we have not seen the kind of damage Israel has taken this time happen in the past. So there is a likelihood that this escalates to something that we have not seen. And this is the first time that Israel has called reservists to the tune of 3 lakh people, its own, people ready to serve the army and the IDF. And the total strength of the IDF is about 1.7 lakh people. They have called 3 lakh more reservists. And they have started collecting blood samples, which is again one of the indications or suggestions that the nation is preparing for a longer war. Usually these actions don't happen for small conflicts which happen for 1 or 2 weeks. So these are first two signs. Third sign is, as I said, that if Hezbollah, which again, as I said, axis of influence, forces in Iraq and Syria, and the Houthis, which generally attack Saudi Arabia, if they get involved, which we've seen, Hezbollah from Lebanon getting involved over the last 24 hours. If there is more involvement, and which I think is the most important statement, if there is any involvement of Iran in an armed conflict, not through statements, but in an armed conflict, then this will become an expanding event. That means it starts on day one. We see very little damage, but then the damage increases over time. So, and now let me put my conclusion and disclaimers, and then let's look at numbers. One, that I do not know what will happen. I have no idea. What I see, or when I look at the data and the history, it appears that this is not an event to be discounted on day one. This is not like Russia and Ukraine war. You cannot push it under the carpet. You have to wait and watch to see how it evolves, at least over the next 1 month. It is not a very small incident, although the countries involved appear far off from where we are. And they also appear insignificant in terms of global trade or their influence on any single commodity. But the area that they influence is very, very large, and it has a massive influence on global geopolitics and energy supply. Now let's look at some numbers on how does this impact global oil, and then how does it impact India. Okay, so let's first go back and build a character on why this is important. So I'll show you one data point. So this is United States trade numbers, imports and exports. You can see this I've marked in yellow. This is energy imports by United States. So for example, in 2007, US was importing $328 billion of energy products. I've summed up all the numbers here. And you can see now today, US is importing minus 74. That means it is exporting $74 billion of energy products. That means from being the highest net importer of energy, US has become the third largest exporter of energy. And if I add up the numbers for gas for 2023, these numbers will become even more larger. What is the context why these numbers are important? When the past conflicts occurred, all these conflicts that you're seeing since 1960s, every time a conflict occurred, United States had a disproportionate problem. And the problem was oil. Okay, if prices went up, it would have hit United States severely because it was reliant not only on the prices but the quantity of oil that it imported from the Middle East. So it is not about the payment of price; it is about running the economy at whatever cost. That number has dramatically shifted, which means that US no longer imports energy from these countries or may not require as much as large imports. In fact, it is now a net energy exporter. So its ability to stay back and do less is much higher than its ability to go and influence dramatically today because its economy can keep on running even if there is a large crisis in Middle East. Second, it has been a very, very large supporter and protector of Saudi Arabia for a very long period of time. And it still is. But the point is that it no longer has to be, right? And this equation becomes even more cumbersome as we enter this new dynamic that has opened up in this weekend. Why? Because as I said, the most important, let me rephrase that comment. The comment that I made that if Iran gets involved in this conflict in a more militarized manner, it will have huge repercussions. And the repercussion will be Saudi Arabia stepping in to take a side. And today we have no idea which side it will take and why it will take, which is not important. But if it takes a side, it will become a big problem. Why will it become a big problem? Let's look at some numbers. So we'll look at the BP Statistical Review by British Petroleum. And I've opened a file here which shows the share of crude oil production in the Middle East. You can see which are the most important countries. A lot of people brush aside and they just only look at Saudi Arabia, which is, of course, 13% of global production. There is also Iran and Iraq, which is about 9% of global production, a very, very large number. And there is also Kuwait at 3% of global production. In totality, 1/3 of global oil production comes from these countries. And 1/3 of global trade of oil also comes from Middle East. And as I told you, this 1/3, all of it comes from the three choke points which I showed you here, right? And these three choke points are enough to strangulate global economy. This point, and this point, right? The the global economy to a very large extent. When Russia-Ukraine crisis broke out, there was a expectation that about 3 to 4 million barrels of oil will go off the market. It did go off the market, but only for the Western countries because India and China picked it up. But this is very, very different. If these choke points stop the flow of oil, there is nobody else supplying the same amount of oil in the same amount of time. So this is something which is important, and we have to understand that if this crisis escalate, and how does it escalate? By involvement of Iran and Saudi Arabia together in a conflict. Can it happen? I think it's a low probability event. If it happens, it is a very high impact event. And that is why we need to be very careful over the next 1 month on what are the developments that overall happen here. Now let's look at what does it mean for India. Okay, and this is only the oil angle. There is one more geopolitical angle which I will talk about later, which depends on capital flows. So let's look at what happens to India. This is a slide that I took from the DSP Netra, which we published about 2-3 months ago. And this clearly shows that what happens when oil prices, go to $100. So if you see Indian crude oil basket, I have taken here, whenever it hits about 100 or so, India's oil trade deficit goes to $100 billion, right? On an average, we hit a $100 billion deficit. And whenever we hit a $100 billion deficit, our external position becomes a little precarious, okay? And lately, what we've been able to do is that we've been able to match our oil trade deficit by remittances, right? You can see remittances have been able to cover it, and services surplus has risen at a very, very fast pace. In FY23, it was $143 billion. So remittances plus services is able to take care of our merchandise deficit to a very large extent, and therefore India becomes much more favorable, right? So I've been repeatedly saying in many conferences and many of these online meetings that $95 oil, India will have some trouble, but we are okay. It's like a Lakshman Rekha. If we get close to it, we are okay. If we cross it, we'll have some trouble. But the question is, what happens if oil prices were to rise significantly, right? If this kind of an event occurs, which is a very, very low probability event, oil prices could shoot up dramatically. How dramatically, I don't know. There are certain estimates which say that if 1/3 of oil supply is disrupted, oil prices could go and make a new lifetime high, which will be very, very disruptive. How disruptive it can be for India? And we'll look at a few scenarios. I showed you that if oil prices go to $100, our deficit numbers become shaky. How shaky do they become and why do they become? Let's look at India's balance of payment. Okay, this is India's balance of payment. This is our current account. Our current account is made up of our merchandise deficit. You can see it is about $267 billion in FY23. Merchandise deficit is the deficit that we import goods, oil, gold, etc., import and export, right? This is the deficit that we run. Our imports are much higher than our exports. On the invisibles, we make inflows largely from services. You can see that $133 billion, generally software services exports that we do. And also we get transfer balance, which is the NRI remittances, right? And we pay income transfer outside. So net number that we get is about $267 billion. This $267 billion has about $100 billion of oil trade deficit. Okay, and that oil trade deficit is at $100 billion if oil prices are between $85 to $95. And that is why I told you that that is the Lakshman Rekha that we have. Okay, let me show you a calculation that I have done for crude oil, right? So this is the year. This is the import that we do for oil in million dollars. And you can see this $129 billion deficit will occur if oil were to be at $100. So this is for FY24, right? So if oil goes to, let's say, $125, our deficit goes to 160 billion. Okay. At $160 billion of crude oil deficit, our external situation becomes very, very precarious. Okay. And this is something which directly impacts Indian economy. It hardens our monetary policy stance. It allows, rupee doesn't allow rupee to be very, very flexible. Depreciation can take place. And this is an outsized event which has a very large impact on Indian economy. And we've seen that over a very long period of time, Indian growth gets stifled if the monetary policy is too tight. And secondly, if our external situation becomes untenable. And I think these two events are of primary importance when it comes to the linkage of these events to India. And second and more important point, which I promised earlier, is a capital flow angle. We've seen that US has been printing a lot of money lately, and over the last few months, we've started seeing signs that it has not been able to manage it very, very well. And which I'll now start with the important slides on Netra, and I will probably go on for another 15-20 minutes before I take questions, and I will try to cover them quickly. But one very important point is that US has been printing a lot of money. Largely, we've seen that when US runs a lot of deficit. So if you see these two lines, this blue area is the US Treasury federal budget. So if it is down, that means US is running a deficit. This is a 3-month average. And this red line is the Fed balance sheet. When the red line is going up, that means the US Fed is buying bonds. It is doing what is called QE, quantitative easing, buying a lot of government bonds. So when the blue line is going down, that means US Treasury is issuing a lot of bonds. It is borrowing a lot of money. And at the same time, the red line is going up. That means Fed is buying a lot of bonds. So in one hand, US Treasury prints money, and the US Fed helps them borrow that money by buying those bonds. So Treasury puts bonds in the market, the Fed buys some of it. This is the first time the reverse is happening. The Treasury is printing a lot of money, right? And the Fed is selling bonds. And this is one of the reasons why US yields have been very, very sticky on the upside. They have risen. One of the reasons, there are, of course, many other reasons. And this is a combination that we haven't seen for a very long period of time, which means very high treasury issuance, and at the same time, Fed not supporting the treasury by issuing or by buying bonds. It is doing the reverse. It is doing quantitative tightening. You can see it had reoccurred here also. The yields had gone to 3.3% even at that point in time, although the magnitude of borrowing was less than half of what it is today. So we are in uncharted territory in terms of US borrowing. And this is one reason why capital flows when there is a global event which shakes the sentiment can get challenged across the world. And this combination we haven't seen in the past happen together. And this is something, this combination can occur, of course, at any point in time, but this exact combination has not occurred. So, which is again another source of uncertainty that we should, completely keep an eye on. And this is one of the reasons why US yields are surging, and this is not a very positive reason. Usually, when yields go up, they indicate that they are playing for growth. Right now, it doesn't seem to be the case because US 2-year yield has not budged at all, while US 10-year has been going up significantly. Wherever the treasury is borrowing money, those yields are spiking, and largely because the marginal buyer, which is the US Fed, is absent from the market. And second, and one more very, very important point, some of you who understand these numbers would have already picked it up. The US trade deficit has been falling post-COVID. It rose very sharply in COVID. It has been falling. A falling US trade deficit means that emerging markets are getting less and less of dollars. So you have a situation where you have less trade flows coming into emerging markets. That means they will not have any FX creation. So China will not have any additional FX creation, and therefore it will not go and buy US Treasury bonds because it doesn't have any excess new money, right? And similarly is the case with many other countries. A very large chunk of buying that US used to do, which is energy, it is completely off the market. Second, a large amount of capital flow used to flow across the world because the US was in a very easy monetary policy. That tap is also closed. You can see in this slide, both these taps tell you that the risk capital, which was flowing across the world freely post COVID, is today restricted. And this is something that we should be cognizant of. When this type of risk capital closes, this tap closes, very high multiples will find it very tough to sustain. And this is one key takeaway, that if this liquidity tap is closing, make sure that you are not in stocks or investments or areas which are overtly valued or are trading at extreme valuations. They can get hurt because this liquidity can be very, very sharp. Second is that US stocks have been very resilient. We've hardly seen any changes. They've been close to lifetime highs. S&P is still just about 8.5% away from lifetime high. So we haven't seen any significant cuts. What is the reason? US corporate profitability has been extremely strong. So if you see these two lines, I've put US corporate profitability, which is the blue line, as a percentage of nominal GDP. You can see it is close to lifetime high, about 10%. We haven't seen this kind of profitability in a very long period of time, right? It was available during, post World War II. We saw this kind of a profitable, not even close, right? We are still much higher than that. And we've seen that one very big contributor to an increase in US profitability, one contributor is ultra low interest rates. So if you see this red line, what is the red line? Fed funds rate minus the long-term nominal GDP growth rate. What is the logic of taking this measure as a measure for how high the interest rates are? Over a very long period of time, what we've seen is that the nominal growth gets reflected in the top line growth. And if companies are able to keep their margins, they will be able to increase their earnings over time, right? They will be able to make profits because top line is going up significantly. So this is directly linked to the nominal GDP growth. So if interest rates go above the nominal GDP growth, the cost of capital becomes restrictive. And we've seen that whenever this has happened over the last 20, 30 years, corporate profitability in US declines. Although you've seen that it has kept on moving higher because every time US raised rates, it cut it to a new low. But now we are back to uncharted territories, and still the US corporate profitability is yet to fall significantly. And this, I think, is a very important development which can happen over the next 12 to 24 months. Where corporate profitability can get challenged. But when you look at the split of market in US, very large corporations, largely technology-driven companies, they are still very, very profitable, right? And there are no signs that their profitability is going down. But we can go many levels deeper, but to cut the chase short, I believe that their corporate profitability can get challenged as economy slows down because these interest rates are highly restrictive. These restrictive rates may not appear very impactful on a weekly or a monthly basis, but every single day spent here over the next 3 months, 6 months, 9 months, 12 months will bite away from US growth a significant chunk, and that will cause corporate profitability to decline over time. And I think right now there is nothing else which is changing. The only saving grace is that US household balance sheets are very, very strong. So even when this whole scenario plays out and corporate profitability declines, the fallback is much more stronger because the household balance sheets in US are much more robust. But that is a story that we'll tell maybe in the future in different versions of Netra. But for now, it appears that rates are tight enough in US to cause corporate profitability to come down. And that is one reason why we believe that US economy could be staring at a more slowness in corporate profitability and possibly a large correction also. And second, there are reasons why a slowdown in US is required. Why? Maybe I've written that the Fed is trying to manufacture a slowdown, and I'll tell you why that view. And so I'll tell you an anecdote. In 2008-9, Ben Bernanke, the then Fed chairman, came on television and in some simple terms, he said that they want higher asset prices. It's a different econ talk, but in such short words, he was telling people to buy stocks because they knew that they wanted higher asset prices, not only in equity markets, but in real estate, etc., to prod the economy back from the crisis, right? And in the last few months, what the Fed chair has been repeatedly saying is that they are playing that wait and watch game. And what is that wait and watch game? They want to see actual data slow down. And this is nothing but telling everyone that they are going to be here unless and until the data slows down to a level that they are comfortable with, which means that they are manufacturing a slowdown. And why they are doing it? Largely to protect the health of the US financial system. So if you go back in history, the red line that you see here is the US federal debt to GDP, okay, which is now close to 120%, 123% or so. And this blue line that you see is federal interest payment as a percentage of nominal GDP, right? How much interest they are paying. We've seen that there are a number of charts and ideas going around in investing circles saying that US is now paying $1 trillion in interest payments every year on the debt that it has. And this is a record number. It has never occurred before. Of course, it has never occurred before in absolute terms. But as a percentage of nominal GDP, which is how you look at it, it has happened before also. When did it happen? When Paul Volcker raised rates significantly to 15, 16, percent. At that point in time, US interest payments as a percentage of nominal GDP peaked at about 5%. You can see here, right? And why was Volcker able to do it? Why was he able to take rates to 15, 16%? Because the debt to GDP was very low at 40%. So Volcker knew that the financial situation of United States was robust. He could protect the currency, protect the financial system by raising interest rates and getting back the credibility of the dollar. Right? Today, the Fed does not have that luxury. The debt to GDP is too high, and we've seen over the last 1 quarter, 2 quarters, the treasury issuances are causing the yields to rise. And this, I think, is a clear indication that the ammunition that Fed has to orchestrate a slowdown is now limited. That means its ability to continue to raise rates is limited by the amount of debt that the US Treasury is carrying. And that, I think, is the biggest joker in the pack. The conclusion of the top 3 slides that I have is that US Treasury is possibly going to take a step back. It is going to say, I can't borrow and keep on spending this amount of money repeatedly, and I'm going to take a step back and not borrow enough, which will not stop the Treasury from paying this $1 trillion. It has to pay, but it will stop the discretionary expenditure the US Treasury is doing today, which will directly hit growth, right? So one way or the other, either through monetary policy or through fiscal policy, US will construct or create a slowdown so that it can set its economic house in order. And this, I think, is the reason why corporate earnings in US can also slow down. And the reason is also because elsewhere outside of US, which is where 40% of US corporations make their profits, there is a widespread slowdown. Except India and some other countries, most countries are struggling for growth, right? So the corporate profitability, the top line, is going to get challenged. And this is, I think, possibly the way the data aligns together. And this also aligns with this new dimension which has opened up on the weekend, which is this war dimension. And why it is important? If the US is forced to enter a war, of course, it will not spend a lot of money. It can spend a few $billions, which it can directly afford. But what it will do is that it will restrict the ability of other countries to step up, because these Middle Eastern wars are very, very pricey. They are very costly because of the geography of the area, and that can cause a squeeze on resources for other countries, specifically if the situations that I spoke about earlier, they happen, and energy prices magnify or go up. It will create a new cost for many of these countries. So this is something which is sort of a vicious circle, and that is the reason why I believe that we need to watch these events very carefully. And again, a disclaimer that there is no crystal ball to say that they will occur. I hope none of this occurs. But this is one way of seeing it, one way of looking at data, which is possibly different than the consensus right now. Consensus largely is that these things happen and they go away. But this is something which I think all of us should be aware of and remember and understand if there is anything new which happens, which is not something that we've thought of. The other is also the US bond market is extremely calm for corporate bonds. You can see the blue line. The spread between corporate bonds and treasury securities is as low as it has ever been, right? So it does not reflect any significant levels of stress at all. And I think it's a level of complacency. The bond markets are very complacent in US right now. Given that growth can slow down, interest cost can remain elevated, and fiscal considerations can roll back. This, I think, is an area which possibly is an indicator that if yields begin to move up, it will show up some amount of stress building up. So this is something that we need to watch going ahead. As of now, it's a complacency indicator when I look at it. And similarly, another indicator that we have is this. If you look at these two lines here, blue line and black line, one is the junk bond yield, and the other is the fixed mortgage rate. Both of them are at the same level. This happens very rarely. When liquidity is extremely abundant, this is what happens. But we've seen that delinquencies in US has started to rise, even for small corporations, and this number is not a reflection of what is happening in the economy. And again, I think one of the indicators that we should be extremely careful watching, at least for the next few weeks and months, is this yield going up? Is the junk bond yield going up in US? If it goes up, it will cause a lot of nervousness. As of now, it's been at one of the most stable levels, a sort of a bullish indicator for today. But I think it does not match up with the ground reality, with what is happening in US today in terms of the slowdown that we've seen in corporate earnings and overall economic growth. And also, if you look at the consumer numbers, interest rates on auto loans is at about 7.5% or so, one of the highest that we've seen in a very long time. Credit interest rates on credit card is at all-time high at about 20-21%. The latest data is still not out, but these numbers are too high, and they are restricting the ability of US consumer to continue to buy a lot more. And you are seeing average earnings are now plateauing, retail sales are now plateauing, and these numbers don't reverse in a day, right? And these are very gradual changes, and they start appearing in numbers with a lag of 3 months, 6 months or so. These are all the advanced indicators which are slowing down. Next is also one more demand indicator from the commodity markets. What we've seen is that demand side inflation has been very sticky. If you see this black line, it has remained high, still at about 3.5%, 4%. But copper prices, which were also high, they have started to come down. And this outperformance that you see, this line going up, this is copper divided by bonds. What does this mean? If this line is going up, that means copper prices are rising at a faster pace, showing that demand is very strong. But this line is right now not rising because copper prices are going up. It is rising because bond prices have been falling at a very fast pace, which means that this ratio is going up for the wrong reasons. And we've seen historically that when that happens, and if the copper supply is very abundant, it usually is a sign that inflation will fall drastically from the demand side, which means that demand side conditions in US or in other geographies is very weak. Okay, till now, last 1.5, 2 years, we focused a lot on supply side inflation and its repercussions. I think this is the first time where we are seeing clear signs that demand side inflation is probably slowing down. And this is precisely what other indicators are also telling us, whether it is the fiscal policy or the balance sheets that I showed you earlier. The next is US dollar. One maybe anti-consensus from my own views that I've showed earlier. US dollar is now as expensive that it has been outside of the Volcker era. The real is at one of the highest level that we've seen. Usually it doesn't last here. And we've seen that if growth slows in US, this will also fall. But with these new developments, I'm not very sure what happens to the dollar in very short term. But one thing is clear that a very large depreciation for dollar can take place. And this will be helpful for safe haven assets like gold. And if you put these, two and two together, financial markets are actually giving you very similar signals. What are these signals? Demand is slowing down, fiscal policy is becoming restrictive, interest rates are too high for growth to continue, corporate profits can fall, and which means that the tenacity and the ability of the dollar to stay here is challenged, and which means that participants are better off moving into safer assets like gold, and possibly waiting for this consolidation or correction to play out. The next is again the similar indication from China, which is a disinflationary indication. China has been a pillar of growth globally. The large four major commodities which account for the modern world today, one is cement, steel, fertilizer, and plastics. Almost all of them are slowing down in China, which is not a sign of how Chinese economies has grown in the last 1.5, 2 decades. But today we are seeing that most of these numbers are not rising, which tells you that A, export demand is weak, B, Chinese own domestic consumption is not picking up at a very fast pace. So this is again an indication that global growth is also very challenging right now. It's not something which is very rosy. Right? India is different. Indian growth is still very strong, but globally that is not the case. Next is, of course, world trade. That growth has also peaked out. You can see these two lines. One is S&P 500 total revenue, and the other is the world trade volume. You can see I have rebased them to 100. That means they are rising at a similar pace, even in percentage change, right? So this is not a directional move. It is actually the percentage change of both these lines, which is the top line revenue of corporates and the total world trade volume. You can see they're going up together. And we've seen a very large divergence recently. And why this divergence took place after COVID? Largely because of technology firms, largely because in the last 12 to 14 months, 12 to 24 months, we've seen that corporate margins have made a comeback, right? Profitability went up. Revenues continue to remain strong because there was a very large stimulus given globally, very large monetary stimulus and fiscal stimulus. All of those stimulus are now over. They are no longer available, and world trade volumes have already started declining. This means that revenue, which is the top line growth for corporates globally, will slow down. And if top line growth slows down, it will directly hit the bottom line because margins are no longer expanding. So please get this statement very, very right. Global top line, if it slows down, it will directly hit the bottom line because margins are not going up. They are either plateauing or coming down. So this is something which is visible in data, but not in actuality right now. It will appear in data maybe in 1 quarter, 2 quarter, or maybe 9 months or 12 months. And why is it important right now? Look at this slide. So this is BSE 500 domestically. You are seeing now 30% of companies saying that their top line is degrowing on a Y-on-Y basis. We have already started a new result season. I don't know what will be this number in this quarter, maybe higher than 35%. This is what the estimates are, which means that more and more companies are saying that the top line is slowing down, which means that the profitability, the estimates that the street has 15-18% will also get challenged, right? So the corporate profitability will also get challenged. So this is something which we have to be cognizant of whenever results are released for companies. If you are seeing top line slowdown and let's say are not seeing margin acceleration, then the bottom line will suffer and those companies will get punished during the result season. But if they are overpriced and we are paying a top multiple for them, then possibility of correction is much more higher. And this is the case with a lot of companies in smaller brackets of small and mid caps. And that is something which is appearing in number also. You can see that the SME index has rallied at 86% CAGR since the COVID bottom, right? Unprecedented. And similarly, 51% for mid caps, 46% for 51% for small cap, and 46 for mid cap, and 33 for large cap. So there is a very large premium that has gotten built in smaller segments. The smaller you go, the higher the premium, and that is what I believe is area of caution for all of us. If the top lines are going to slow down and profitability is going to slow down, why would we pay a very high multiple for these companies? So this is the question we need to ask, not about today, not about the trend, not about how the 1 day, 5 day price change is going on, or what is the performance of the last 3 months, but what is the actual profitability scenario that we see today is very, very important. The next is we look at where we are today and what have we done when we were in similar brackets in the history. So when you look at the price to earnings multiple for Nifty, we are somewhere at 22.5, 22.7 range in this bracket. And when you look at the Nifty ROE, today we are at 13%, so roughly in this bracket. When these numbers occurred in the past, our 3-year forward return was just 9%, right? And today, some AAA bonds, FRBs are yielding 8% or so. So the ability of the equity markets to outperform is challenged. And what is the reason? High multiples. So, and what is the correction? If price is correct, multiple becomes more amenable. I think our outlook will improve and it will be a very, very healthy situation for the domestic market. And that is why we believe diversifying across assets is the right strategy right now. And we believe that specifically for gold and other safe haven assets, it would be a good time to hold them. Last, of course, is a very long-term chart which we put for India. We think that structurally there is a question now whether we have entered a new high growth phase in India. But that could be true. Many indicators show us that Indian growth is now picking up, and the numbers are unlike the past. They appear very, very robust. 5-10 year numbers appear very, very strong. But the point is that we have to pay the right multiple for getting the upside of this kind of growth. We can't pay top dollar and then also make top returns on top of it. So this is the most important takeaway from this. So just to put things in conclusion and maybe end here, one is that the event that we spoke about has repercussions. It is an event which will expand over the next few days or weeks. If it ends in a few days, I think that is the best outcome that we can have, and I hope that happens. But we need to be very aware and cautious on how this happens, specifically because our valuations are high. Second, we believe that monetary and fiscal policy, both in US and other countries, have become restrictive. It will hit growth. Corporate top lines could suffer, and therefore corporate profitability could also suffer, which is a headwind. And therefore, we are saying that be cautious on equity markets. We feel that disinflationary trends are picking up across the world, and which is a sign for corporate profitability. And this is the right time to diversify across other assets because domestically valuations are high. India appears to be in a strong growth trajectory. Our corrections are much more shallower than other countries, so it could be a good opportunity. But I think we are still away from that opportunity. Once it occurs, we'll be able to possibly be able to capture some of it, and we'll be ready for it.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.